Hello everyone. So this is our lecture number 5 where we continue our discussion on the same module, issue of shares and allotment of shares. So before I proceed further, which we are going to discuss in this class, let me take 1 or 2 minutes so that you can understand what we learned in our previous class. So in the last class we focused on issue of shares procedure because company is a large scale business which is raising the capital by issuing shares to the public, and we understood that companies cannot think of its own rules and regulations to issue the shares. Rather, it has to follow the guidelines given by the Companies Act as well as the guidelines given by the SEBI, Securities and Exchange Board of India. So whatever rules and regulations are there given by the Act and whatever procedures given by the SEBI, so by following all those rules and regulations, companies issue shares to the public to raise the capital. And before that, company has to give the information to the public that the particular company is issuing shares to the public. So how to inform the public? So we discussed one more concept of prospectus, where it is a document which gives all the details of the company, including number of shares and classes of shares that company is going to issue. So classes of shares, again, whether it is equity shares or preference shares or both the type of shares. Okay. So after giving all these information details to the public through prospectus, so public they subscribe for company's share. So why we are doing all these procedures? We, in the sense the company, because all these are as per the guidelines, as per the rules and regulations. So I think all those concepts we discussed in our previous class. So here again, coming back to this part of discussion, when company is issuing shares, of course we are in the beginning stage, so that we can find the monetary transactions and later we account for all those transactions. So when you are issuing shares, when company is issuing shares to the public, so there are some terms of issues. Terms of issues. So how shares are issued? How shares are issued? So we know that shares are nothing but the units of share capital with definite values. For example, we continue with the same example which we took in our previous classes. So ABC Company Limited. So one of the joint stock companies which wants to raise 10 lakh rupees capital from the public by issuing shares. So what is the total number of shares? 1 lakh shares of rupees 10 each. Okay. So 1 lakh shares of rupees 10 each. All these are units with definite value. Okay. So what is the definite value here? Per share 10 rupees. Per share 10 rupees. So if company is issuing the shares to the public at this face value or nominal value, we call it as issue of shares at par. Sometimes company may think of issuing shares to the public more than the face value, by charging more than the face value, which we call as issue of shares at premium. Sometimes company issues shares to the public by charging less than the nominal value or less than the face value, which is called as issue of shares at discount. So let me clarify. All these concepts are called as terms of issues. So what are the terms of issues? Issuing of shares at par, issuing of shares at a premium, issuing of shares at discount. Okay, because we are dealing with the monetary values. So we have 1 lakh shares of rupees 10 each and company wants to raise the capital of rupees 10 lakh by issuing all these shares to the public. So this company issues to the public. So while issuing all these 1 lakh shares to the public, how companies are going to issue? How company issues? If I take a particular example, ABC Company Limited. How ABC Company Limited issues 1 lakh shares to the public? What are the terms of issues? Okay, so ABC Company Limited can issue the shares at par. So what is this at par? At par means same face value. So company divided total capital into units, 1 lakh shares of rupees 10 each. 10 is the price of one share, or per share price is 10 rupees. Okay, so that 10 rupees is already fixed by the company. So later classes we are going to discuss about this particular price, base value or issue price, how companies are going to fix the price of the shares. But before that, 1 lakh shares of rupees 10 each. So what is this 10 rupees? That is per share price. So when this is per share price, coming to the example, 1 lakh shares are issued to the public. So company has to charge the price for one share. Okay, so 1 lakh shares of rupees 10 each. If 1 lakh shares are issued to the public at rupees 10 only, 1 lakh shares are issued to the public at rupees 10 only, that is called as issue of shares at par. So what is the ultimate meaning of issue of shares at par? When shares are issued at a price, when shares are issued at a price which is equal to, which is similar to or same to the face value of the share. When shares are issued at a price which is equal to the face value of the share is termed as issue of shares at par. Okay, so 10 rupees per share. So company is issuing to the public all these 1 lakh shares by charging the same price, which is called as issue of shares at par. So that is one term of issue where company is issuing shares to the public. Now second thing, issue of shares at premium. Issue of shares at premium. So I take some addition to this total number of shares at total number of shares of rupees 10 each. So I add here 1 lakh shares of rupees 10 each, 1 lakh shares of rupees 10 each plus premium of 10%. So it will be like this: ABC Company Limited issuing 1 lakh shares of rupees 10 each at a premium of 10%. Or ABC Company Limited issued 1 lakh shares of rupees 10 each at a premium of rupees or premium of 10%. So premium can be given in the form of percentage or sometimes in the form of rupees. Okay, so 1 lakh shares of rupees 10 each at a premium of 10%. Now what is the issue price of the share? What is the issue price of the share? Face value is 10 rupees only. Face value is fixed by the company, that is 10 rupees only. But while issuing these 1 lakh shares to the public, company is mentioning that 1 lakh shares, ABC Company Limited issued 1 lakh shares of rupees 10 each at a premium of 10%. So this premium of 10%, on which amount this premium of 10% is to be applied? Okay, so this premium of 10% is to be applied on the face value of share. So what is 10% of? 10% of rupees 10. Okay, so 10% I am going to say 10 by 100. 10 by 100. So 10% of rupees 10. So that comes to 1 rupee. 1 rupee. So in terms of rupees, company is charging 1 rupee premium per share. on every share that is issued to the public. Okay, in the form of percentage, company is charging premium at the rate of 10%. So we are finding a difference here. Difference I mean to say, face value is 10 rupees, but issued price is 10 rupees plus premium of 10%. So total issue price becomes 10 plus 1 rupee. Okay, so rupee 1 plus rupees 10. Total issue price is 11. Now you can find the difference here. Face value 10 rupees, issue price 11 rupees. So how to interpret this? How to conclude this particular situation? So here we can identify that face value of the share is 10 rupees, but issued to the public, the shares are issued to the public where per share price we are getting 11 rupees. So that means what? When companies are issuing the shares at a price which is more than the face value. Okay? When companies are issuing shares to the public at a value which is more than the face value. So that is called as issue of shares at premium. So here, in the case of issue of shares at par, shares are issued at a price which is equal to face value. So in the case of issue of shares at premium, shares are issued at a price which is more than the face value. So how we are identifying that it is more than the face value? ABC Company Limited is issuing 1 lakh shares of rupees 10 each at a premium of 10%. So 10% of 10 rupees, we are getting 1 rupee. So issue price is 1 rupee plus 10 rupees, 11 rupees. So this 1 rupee premium again income to the company. So per share we are getting 11 rupees, 10 rupees face value plus premium 1 rupee. And again we know how this is to be accounted for. So while discussing practical problems, we make the treatment for this premium. And now it is called as securities premium, not share premium. Because we know that when we are issuing all these shares to the public, all these shares are called as financial securities or financial instruments. Okay, so when companies are issuing shares at premium, this premium is called as securities premium. So which is the income to the company. So that is the second term of issue of shares at premium. Then we have one more thing or one more terms of issue of shares at discount. Issue of shares at discount. Now here I take the same example. 1 lakh shares of rupees 10 each. Okay. ABC Company Limited is issuing 1 lakh shares of rupees 10 each. So instead of premium I take at a discount of 10%. So hoping that you know the concept of discount. Discount means reduction in the actual price. If I go to a shop, the shopkeeper says that if I want to buy a trouser, shopkeeper says that it is of 100 rupees. So I ask, is there any discount for this particular product? So he may say that I am giving you 5 rupees discount. Okay. So what is the actual price of the trouser or shirt? 100 rupees. So he is saying that I am giving 5 rupees discount. So what is the actual amount I am going to pay? 100 minus 5 rupees. So 95 rupees I am going to pay. So this shirt or trouser example what I said, assume that that is the particular share. So if we take the same example, 1 lakh shares of rupees 10 each at a discount of 10%. So how to apply this 10% discount? Similarly or same thing, 10% of face value. Because we take the concept of discount when there is the price, when there is the actual price for the product. And we know that all these shares, debentures or bonds are nothing but financial products. Okay, so all these are the financial products. So on that also we give the discount. So here 10% of 10 rupees. Same thing, 10% of 10 rupees. Again we are getting 1 rupee. Okay, so 1 rupee. But this 1 rupee is not the premium, this 1 rupee is the discount. Okay, so we are saying that if X is purchasing or Y is purchasing 1000 shares or 2000 shares or any number of shares, 3000 shares, okay, we are giving you 10% discount. So what is the amount the purchasers, the buyers, what is the amount which they are going to pay when you are issuing all these 1 lakh shares at a discount? So when they are purchasing the shares, assume that X is purchasing 1 share. So what is the actual price of 1 share now? So 1 rupee discount, face value is 10 rupees. So 10 minus 1, 9 rupees. So X is going to pay 9 rupees. So hoping that something we are observing here, that our issue price or actual price or face value is 10 rupees. But while issuing these shares to the public, we are giving them 10% discount, where we are going to collect lesser than the face value. So altogether we can say that issue of shares at a discount. Here, when company is issuing shares at a price which is less than the face value, when companies are issuing the shares to the public at a price which is less than the face value. So what is the less than the face value here? So 10 minus 1 rupees, 10 minus rupee 1. So issue price is 9 rupees. Okay, 9 rupees. So even though we have face value of rupees 10, but we are issuing to the public the same shares by charging 9 rupees, because we are mentioning that ABC Company Limited issuing 1 lakh shares of rupees 10 each at a discount of 10%. So when the shares are issued at a price which is less than the face value or nominal value, that is termed as called as issue of shares at discount. So 3 terms of issue of shares at par, issue of shares at discount, issue of shares at premium. Now I said earlier, when shares are issued at premium, more than the face value, more than the nominal value, it is somewhat income to the company, and we know the accounting treatment. Of course, later we are going to discuss. It is an income to the company, and we take this under a separate heading called as securities premium. Now the question is, when shares are issued by the company at a discount, again it is an expense or loss to the company, because you are saying that face value is 10 rupees, but your issuing price is 9 rupees. So 1 rupee discount. Okay, so what is the treatment for this 1 rupee? So again it is a loss. We show this amount of discount under the separate heading called as discount on issue of shares. Discount on issue of shares, because that is also taking place in terms of monetary values. Even premium is also taking place in terms of monetary values, and we know that whenever there are monetary transactions, that is to be accounted for. Okay, so mainly 3 terms of issues, because we are dealing with issue of shares. So one thing, companies can issue the shares at par, where we say that, or where the meaning of issue of shares at par is issuing of shares to the public, or when the shares are issued at a price which is equal to the face value or nominal value. Then issue of shares at premium, when the shares are issued at a price which is more than the nominal value or face value. Then issue of shares at a discount, when shares are issued at a price which is less than the face value. So anyhow, whatever may be the terms of issue, but for each and every transaction we have to account for. So this is one concept of the same module, issue of shares and allotment of shares. So further we focus on some other concepts of the same module, that is new issue procedure or new issue share or I can change the heading as ways of issuing shares or methods. Ways of WAYS, ways of issuing shares. We call it as methods. Methods of issuing shares. Because in the previous classes we discussed that we are issuing shares to the public, and before we issue shares to the public, we go through the guidelines, we go through the rules and regulations given by the Companies Act as well as the rules and regulations of the SEBI. Now, when companies are issuing shares to the public by filling all those required documents and by following all those conditions, rules, so how they can issue the shares to the public? So what are the methods prescribed? What are the methods followed to issue shares to the public? Because we know that if I am the company, ABC Company Limited, where they have 1 lakh shares, they cannot go personally asking the public that we have 1 lakh shares, please purchase these shares. Correct? So all these things are not there. We know that as per the guidelines we have to commence our activities. So what are the methods provided by the authorities to issue the shares to the public? So in that we have mainly 3 methods. Number 1, it is IPO, that is initial public offering or offer. Initial public offer, where if I continue with the same example, ABC Company Limited is issuing 1 lakh shares to the public, so they can think of the particular method IPO, initial public offer, and this takes place in the primary market where company is issuing 1 lakh shares of Rs 10 each to the public. Okay, because we have 2 different markets when we go through financial markets. And we know that all these are the financial securities, so we need a particular platform mechanism where we can exchange all these financial securities, and that is provided by the Indian financial system, where one of the components of Indian financial system is financial markets. So it is the market where we think of exchange of financial assets, financial securities or financial instruments. Okay. Now this share is nothing but one of the financial securities that we can exchange in the financial market, so that company can think of raising the capital. Okay. So in that financial market we are finding 2 different headings. One is primary market, one is secondary market. So again we have 2 more classification. One is money market and capital market. Okay. For time being we try to understand what is this primary market and secondary market. Okay. So let me take the same example. There is ABC Company Limited in the corporate sectors. Okay. And there are public. One common thing here is because of the financial system, where we know that it is nothing but, this financial system is nothing but management of public money. Okay, the system has to manage the public money. So because they are the investors, they invest their surplus amount, whether in shares, debentures or any other financial or in any other financial securities. So it is the responsibility of that system to manage the public money. So here is the company, ABC Company Limited, and here we are finding the public. Okay, so taking the example of initial public offer, okay, where we are finding that company wants to raise capital of rupees 10 lakhs, which is divided into 1 lakh shares of rupees 10 each. When all these shares are directly issued to the public by this ABC company limited, when 1 lakh shares are issued by this ABC company limited to the public directly, we call it as primary market. Primary market. And one of the methods provided by the Act or SEBI is initial public offer. So initially, you can give the offer to the public saying that we are issuing 1 lakh shares of rupees 10 each. You can invest in our company's share. So both are benefited. Public, they are purchasing the shares. In return, they will be given a dividend, and company can raise the capital. Okay, so just one method of raising the capital. One method of raising the capital, that is IPO, initial public offer. Because we are raising, the companies are raising the capital through the public only. That's what they have given the name, initial public offer. So second method we have rights issue. So one more method of raising the capital. So everywhere company wants to raise the capital because we know the nature of the capital. So whenever company raises the capital, it helps the companies to think of further developments. Otherwise, we cannot think of expanding the business, we cannot think of diversifying the business, we cannot think of promoting our business. So it is the capital which is the essential element for the companies to think of developing the company's business. Okay. So what is this rights issue? So rights issue means, if I take the example, assume that there is the same company, ABC Company Limited, so which wants to raise the capital through rights issue. Now what is the concept of rights issue here? So rights issue means offering shares to the existing equity shareholders only, offering shares to the existing equity shares only in proportion of shares held by them. So there is no question of new shareholder. So whatever existing shareholders are there, for them only company is offering additional shares. But condition is in proportion to the shares which is already held by them. Assume that same share capital, 10 lakh rupees. So there are 10 shareholders in that company who have contributed towards the capital. Okay, for them only, if company issues additional shares in proportion of shares held by them. So what is that proportion? X is holding 20,000 shares, Y is holding 25,000 shares, Z is holding 30,000 shares. So whatever already shares are there with them, so according to that, company may say that for 10,000 shares, we are issuing additional shares of 1,000. For 20,000 shares, what is the number of shares? Or company may say that for 1,000 shares, we are offering additional 5 shares, 10 shares. So what is the number of additional shares to be issued to the shareholder who is holding 20,000 shares? Okay, so this we call as proportion, so that it is somewhat justice to all the shareholders. Otherwise, shareholders, they may say that for X you are giving more number of additional shares as rights issue, for Y you are giving less number of shares. Okay, so we find injustice. So to ignore all those things, we or the company thinks of issuing additional shares to the existing equity shareholders in proportion of shares held by them, which is called as rights issue. Again, we have to remember here one more method of issuing shares. One more method of issuing shares where company wants to raise its capital. And lastly, we have Private placement. Okay, so private placement. So that means already existing company issues additional shares to the people who are privately connected to the company. Because in the companies we are finding the board of directors, the chairman, managing directors, employees. Okay, so board of directors, managing directors, or chairman of the company. So those who are close to the activities or to all these different parties. Okay, when company is issuing shares, additional shares to all these private people or closely connected people, we call it as private placement. Again, here we are not going to find any kind of new equity shareholders. So already those who are privately connected, whether from the board of directors side or chairman side or some other employees. Okay, for them when company is issuing shares, we call it as private placement. Okay, so already we have discussed different methods or ways of issuing shares. So IPO, initial public offer, rights issue, private placement. So one common thing we are finding here in all these methods that whatever be the method followed by the company, ultimately company's focus is, company's intention is to raise the capital so that companies can think of further developments. Okay, so with this I conclude today's discussion. So where we discussed two new concepts connected to issue of shares. One is terms of issue, where companies are issuing shares to the public. Three terms we discussed: issue of shares at par, issue of shares at premium, issue of shares at discount. Okay, then when the company is issuing shares to the public, under which method companies can issue the shares to the public. So we have three different methods. We call it as ways of issuing shares: IPO, initial public offer, rights issue, then private placement. So in the next classes, again we are going to discuss about same concept, issue of shares, where we focus something on SEBI's guidelines. Then we account for the transactions that are taking place in the company's activities, especially the transactions which are measured in terms of money. So we account for all those transactions. So with this I conclude today's class. Thank you.